Hey there, Troy Redstone here with PhD Retirement Consulting. Just a quick word. I know that we've got an election coming up, and a lot of people are asking questions about what to do with their retirement, how to build wealth during a pandemic, much less in an election cycle. And so I just want to kind of address some of those questions and possibly even fears that you have, and just whatever questions you might have. So I'm going to make sure that you have my contact information if you want to reach out and set up a time. What questions are on your mind? I know the questions that we're getting, and maybe these are questions that you're asking. A really obvious one is like, should I even be investing right now in this kind of crazy 2020 year? And the really easy short answer to that is, yeah, absolutely. It's a great time to be in the market. We're going to kind of unpack that a little bit more because there's some different nuances to that. Another related question, though, would be what's going on with our retirement plan? It's kind of interesting. Actually, your plans should look fantastic because the market's rebounding, and it's really been a very, very good market this year to actually grow your money. And that's probably what you're experiencing if you looked at it recently. Another thing you may be wondering is what's going on with kind of the general economy. And this is kind of interesting one. I will say that the economy was really, really strong coming into 2020. Low unemployment, great stock market, like an 11-year bull market. GDP was strong. Everything was really, really strong. And then the plague hit, right? And so that was obviously unprecedented, but it was a really, really strong economy before all of that hit. We've already seen the markets begin to rebound. We definitely had a negative growth in the first quarter because the markets dove in March. And so negative growth in the economy at the end of first quarter, negative growth at the end of second quarter, but over 31% GDP, shattered all the records at the end of third quarter. So that surprised a lot of people. What's going on with the stock market? We're going to talk about that. I'm going to actually share an illustration using a particular index, and this is the Dow Jones Index. Typically speaking, if you're watching the news and they're talking about kind of how the market did or whatever, they're probably referring to the Dow Jones. There's a number of different indexes out there, like the S&P 500 index, things like that, but we're going to refer specifically to the Dow. So what's going on with the Dow this year? Well, at the beginning of the year, the Dow was actually at 28,800. Now, about a week ago or so, when we prepared these slides, the Dow was at 28,800. That was as of October 12th. So believe it or not, the Dow is almost exactly where it was at the beginning of the year. So you'd say, well, has it been flat this year? Because that hasn't been our experience. Well, it actually hasn't been flat this year. In fact, it's been a lot better than flat. It's been up and down, and I'm going to tell you why that's actually a good thing for your account. So it's interesting because different people experience, these. Some people think this is beautiful. You look at a big, flat, open space, see the sky forever, right? My wife thinks this is beautiful. I love the mountains. She loves the open prairie where everything is super flat. We live in Kansas, so you can see who won that fight. But the question really is this attractive to you? Because I think some people say, boy, I wish things were flat. I wish it was kind of a slow, boring, not much anxiety involved. And because this is not at all what the market looked like. This is actually what the market looked like this year. My question for you, I guess, is which looks better from where you're sitting right now as we sit upon the eve of the election? Is it this, or is it this? The market was exactly the same place at the beginning of the year as it is now. Would you rather have this type of a path or this? The funny thing is, the wide open space, the flat, that might actually feel like it's a better approach. You probably have a lot less sleepless nights, but I will tell you that what you're looking at now with the up and down is actually more conducive to growth. So this is what actually happened with the Dow Jones this year. 28,800 at the beginning of the year. It shot up to 29,500 in February, all-time high. But then, of course, it dove in March 23rd. So you had an $18,500 drop, or it actually dropped 18,500, and then, of course, it rebounded by the end of the year. But what a lot of us experienced and what a lot of us remember in March is all these reports about how the Dow had dropped over 30%. from its high until its low. Even though it rebounded, it was a huge drop. I'm going to tell you why that V-shaped type of a response or that V-shaped type of a path is actually advantageous for your retirement account, and why this is not something that should be nerve-wracking to you. I want to explain it like this. Let's say, for instance, you had a stock or anything like some product or a widget or anything, and let's say it was priced at $100 at the beginning of the year. In February, let's say it shot up to $110 in value. Now you could sell, if you bought it for $100, you could sell it for $110 in February and you could make a $10 profit. Or you could buy more at $110 and hope that it keeps going up, right? What actually happened was after it went up to $110, it was then valued at only $75. And then it was valued at $50. It got back up to 75 and eventually it got back up to 100. So your product, your share, or whatever that widget is that you're thinking of in value, it was $100. A year later, it was $100, but it did change in value. It actually changed to your advantage. So it wasn't flat. It wasn't it actually went up and down, up and down. The interesting thing is when it goes down, you're able to buy it for, let's say, $50. And then when it comes back up to $100, you doubled your money. So that drop down there is kind of the dip. And when you're able to buy the dip, that's what actually accelerates the growth in your account. Now in the stock market or in retirement planning, we call this dollar cost averaging. It's a huge tool for you to kind of build wealth because your money keeps going in, even though it's going in at different levels. If it went in at the same level all year long, you wouldn't be making nearly as much money as when it goes up and down, up and down. So the actual up and down of everything works to your advantage. What's wrong with this? Well, human nature. This is definitely the better path, but we don't have the ability, for whatever reason, we don't have the ability to kind of stay on the path. We don't stay the course. Our emotions get involved. We get nervous. We do the wrong thing when it comes to money. We just don't stay on course. And this is a great example. I love this picture here. The city actually decided, hey, when the light turns red and people are trying to cross the street, they don't just go north and south, east and west. Sometimes they want to go from that corner to that corner. They want to cut straight across. So we're even going to have a crosswalk in the middle diagonally. But as you can see from the picture, people don't actually stay in the path. So it's human nature to kind of veer from the path. This is kind of what's going on with the stock market. It's an up and down type of a deal. You have to understand the up and down is not necessarily a bad thing. The market goes up, the market goes down, the market goes up, the market goes down. This is kind of how stock markets work. By the way, this doesn't mean it's wrong. I mean, the stock market's not wrong. The stock market does what it's going to do. But when it goes up, what's our emotional response to that? When it goes up, the emotions, the feelings are fueled by what I'd call greed. Like we want some of that growth. Like we get excited when the market goes up. Now all of a sudden when it goes down, the emotional response is one of fear. And that works exactly against that idea of buying the dip. Instead of buying the dip, we're selling when we get to the dip, which is the exact wrong thing. Like you don't want to buy high and then sell low. Buy high, sell low, buy high, sell low, repeat until broke. This is a certain formula for disaster. And this is what you don't want to do. Unfortunately, the stock market and the way money works is rather like a roller coaster sometimes. You've probably seen this picture if you've ever been in any of our meetings or seen any of these webinars before. It's my favorite picture of the stock market. What's happening here with these two friends is they're on a roller coaster, right? What's interesting is they're on the exact same roller coaster, but they're experiencing it completely different. So it's not like one person's on a really crazy wild roller coaster and the other one's like on this little kiddie roller coaster and it's really, really tame. They're on the exact same roller coaster. They're in the exact same car. Okay. So they're having the exact same experience. Well, not exactly. One of them is completely freaked out and one of them is just like, no big deal, right? This is a lot of fun. So you have to understand roller coasters, the roller coaster of the stock market is not right or wrong. It just is. It just is what it is. The market's going to yield what it will yield. Their response to it, okay, that's also not right or wrong. We're wired, some of us wired to be more embracive of risk, and some of us are just wired to be more risk averse. And that's not a right or wrong either. It's just kind of the way you're wired. What's important is to understand that this person right here, when she sees the up and down, she wants to make sure she's on a path that's not quite as far up or quite as far down. Okay, so if you see the yellow line here, the yellow line doesn't go up quite as much as the market on its high, but then when the market goes down, it doesn't go down quite as much either. That's advantageous. She's willing to give up some of that high side gain for the lack of so much downside loss. Now, if she starts comparing notes with her coworker and she says, well, gee, Susie has a better rate of return than me. Yeah, that's because Susie can stomach that kind of a roller coaster, and you're not. You get really nervous about that, so you didn't want to be on that roller coaster. So this is actually what she wants, because she gets freaked out. Her friend Susie, this would never work for her. When the market goes up, she actually wants to see all of that upside, and she's willing to do that knowing that there's also going to be a lot of downside, but she's okay with that. It's okay to be up, it's okay to be down. The roller coasters are going to be what they're going to be. You have to understand the way you're wired and where you should be on that path and how your portfolio should be diversified. The only thing that's wrong is she's not wrong for being too conservative. She's not wrong for being too aggressive. The only thing that's wrong is if you're on the wrong type of a roller coaster, like you're super conservative, but you're on a really aggressive path and you shouldn't be. That's not a good idea. The other thing that's wrong though is that when you get to the bottom, like you're in that dip and you get really nervous and you overcorrect and you move everything to cash, that's wrong because you're in the wrong portfolio. So you want to make sure that you're appropriately diversified so that you're not tempted to actually make any sudden changes. We all know what happens when you kind of make a sudden correction on an icy road, right? You don't want to overcorrect on an icy road. Very, very dangerous. So keep this in mind. Make sure that you're appropriately diversified, particularly with all the craziness that's going on right now with 2020. Let me share with you real quickly 3 keys to success. The first key to success is going to be how much you save. How much you put in is way, way, way more important than where you actually invested. It's not to say that the investments are not important. It just means that the how much is way more important. I like to say it like this: if you don't put enough fuel in the tank, you're going to run out of gas before you get that engine or that vehicle all the way across the finish line. So how much is way more important. The other thing though that's pretty doggone important is just consistency. So that's kind of staying the course, right? It's if it goes down, you buy the dip, but you stay the course. If we use the roller coaster illustration, it's kind of like this. You want to make sure that you keep your hands and your feet inside at all times. You want to make sure that you're not being crazy. Like you get on the roller coaster and you're like, this is going way too fast. I don't like how scary this is, and you try to jump off. That's a really bad idea when the roller coaster is already moving. So you just need to be consistent and stay in the portfolio that you're in. And if it feels too aggressive, we can reallocate you to a more conservative portfolio. But don't get scared into making any sudden changes that are not wise for your portfolio. Okay. The other thing, the third part of success, is avoiding pre-retirement distributions. 2 different ways to think of this. You don't want to take money out of the market when it's the wrong time, like moving everything to cash because you're nervous, but you also don't want to take money out of the plan. So avoiding loans, avoiding coronavirus related distributions, avoiding distributions from the plan, because that's actually going to wreck your ability to retire on time. Okay? You may have heard, by the way, there's an election coming up. Obviously there is, right? And a lot of people are asking the question like this, like, what happens if the market goes down? I don't know if the market's going to go up or down. I will tell you, historically, election cycles have not been bad for the market, so there's no reason to suspect that it might go down, but it may. What I want you to remember is if the market goes down, that's not necessarily a bad thing. That's not necessarily bad if you're still investing, if you're buying. You actually want to buy the dip. If you're still building wealth, it's not a bad thing. If you're close to retirement, it's not a good thing. You definitely want to make sure that you're more conservatively allocated if you're heading into any kind of thing like an election cycle. The election actually is not what should cause change. Change is, you're going to hear a lot about change. You've heard a lot about change. Change is kind of a big word in this particular election. There's a bunch of folks out there that want to change what's going on with our country right now. Let's talk about change. Let's talk about change as it impacts your retirement account. When should you make changes in your retirement account? Well, Based on your age might necessitate change, or based on your time horizon, like how close you are to retirement. Your own circumstances, in other words, should possibly warrant changes in your retirement account. Should the market warrant changes in your retirement account? No. Believe it or not, no. Outside circumstances should not necessitate changes to your retirement account or to your portfolio, nor should elections cause changes to your portfolio. So just keep in mind, as we head into an election cycle, I am not saying that the markets won't go down. They may. In fact, the markets didn't end so well in October. They're going to say it's because of coronavirus or whatever. So it's going to be that some people are nervous about the market. Will the markets go down? They may. Will the markets go down as much as they did between February and March? Unlikely. But the point is, you got to make sure that you're changing for the right reason. And you don't want to make changes based upon external circumstances like an election. You want to just make sure that you're on the right roller coaster, that you're on the right cart on that roller coaster, and that you just hang in there. So I know that's a question that some people are asking, and I'm happy to get with any of you and kind of talk one-on-one about your particular circumstances, but it's your circumstances that are going to impact change or necessitate change. It's not going to be anything like an election or external circumstances. One other thing that doesn't change, by the way, is how you put your financial house in order. This has not changed. It's a tried and true method, and the steps are really, really effective, and we really need to work them in this particular order. You have to make sure that you have an emergency fund, and then eliminate debt. The debt is actually like a weight. It's like an anchor keeping you from being all that you can be, keeping your money from being all that it can be, keeping you grounded and not really kind of growing. So you want to get rid of that debt. But if you just try to tackle debt without first setting up an emergency fund, then you're going to have some type of an emergency, a hurricane, an ice storm, something happens to your house, something happened to your car this morning, something happens where you have to dip right back into money or credit cards and accumulate more debt if you don't have the emergency fund before you start trying to tackle the debt. So set up an emergency fund and then try to tackle that debt. You want to make sure that the interest out there, interest is not bad, by the way, but you want to make sure that it's interest being paid to you and not interest that you're paying. As soon as you realize that interest is paid to you as like a reward for having your financial house in order, okay, and interest that you pay is a penalty for living beyond your means. As soon as you realize that, you're going to realize that it's important to make sure that you get your financial house in order. And then we can talk about savings, whether it's short-term savings like for a car or long-term savings like for retirement. But you want to tackle that after you get your financial house in order. The other thing that's really important is paying off the kids' college or paying off your house, but that comes after you've actually started building money for retirement and building wealth. So this is a fantastic market to be building wealth in, but it calls for some discipline like we've never had before to kind of stay the course and be consistent and continue saving, and possibly even saving more if you're not putting enough in right now. We recommend 10 to 15%. You've got to make sure you're putting enough in to get it working for you. This is a market that absolutely is building wealth for a lot of people, but you've got to make sure that you're building your financial house, getting it in order first, and then building wealth. Okay. If you follow these steps, it'll lead to what we call financial peace. Okay. So we want you to have freedom. We want you to have the ability to kind of control your dollars and not be controlled by them. Dave Ramsey has a saying that when our money comes out, our stupid comes out. And it's just that our emotions get involved. We do all the wrong things. We do exactly the opposite sometimes of what we really know we ought to be doing. So freedom is really, really the key. I want you to be able to experience the financial freedom to start living on purpose. So here's my contact information. Everybody probably knows how to reach us already, but here's our toll-free number. It's 844-PHD-401k. So call our offices anytime. If you don't reach somebody, because a lot of us are working remotely, make sure you leave a message and we'll get back to you, or you can email me directly. The reason to email me is to say, hey, I'd like to set up a one-on-one Zoom meeting, or I'd like to set up one-on-one conversation or a phone call or whatever. And we want to be available to you to talk to you about your particular situation, because your situation matters. Your situation is the thing that might warrant a change to your plan. So please, please, please don't do this on your own. That's probably my best word of advice as we're heading into craziness, as we're in a pandemic, as we're heading into an election year. My best word of advice is don't do this alone. Okay, reach out to us. We're here to help, and let us know how we can help. Okay, stay connected. I'm pretty easy to stay connected with on LinkedIn. Our company also has a LinkedIn page. You can connect with me on Facebook. Our company also has a Facebook page. I'm on Instagram, and our company has a YouTube channel. So if you're not currently subscribed to our YouTube channel, you should be. Make sure you go out there to YouTube. There's a whole bunch of videos on like how to budget, how to make money work, and just how to kind of get a handle on things during uncertain times. So reach out to us and let us know how we can help. I also have a Twitter account if you're into that kind of a thing, and basically you can find that just at Repurposement. At Repurposement is going to be the name of the, well, Repurposement is the name of the book. And I will tell you that if you go to any of the socials and reach out, like or comment or whatever it is, if you'll connect with me on the socials and make sure that I know like who you are, because there's a lot of people around the country we work with. Make sure you connect with me and just say, hey, I saw your video. Thanks for the information before the election, something like that. So I'll know that it's in response to this. I'd be happy to send you a free copy of my book, Repurposement. So we appreciate you. We appreciate your time. And thanks so much for the ability to serve you. And hang in there. This crazy year of 2020 will be over before you know it.